Right now, AiRWA Inc., trading under the ticker YYAI, is at $1.55 a share, and it is having a very rough morning, down just under 10% for the session. This is not a gentle dip. It is a continuation of a catastrophic collapse. The stock is trading with heavy volume, already over 1.5 million shares changing hands, and it's fighting to hold a new 52-week low, which it set just moments ago at $1.44. The immediate reaction, seeing a stock at $1.55, is to dismiss it. The expectation is that this is just another failing microcap, a piece of market static, a company on its last legs. But the reality of AiRWA is so much more complex and, frankly, more chaotic than most investors realize. This isn't just a company having a bad year. This is the aftermath of a total implosion. The 52-week high for this stock is not $5 or $10. The 52-week high is $274.50. You are not misreading that. This is a 99.4% wipeout. This is the kind of chart that institutional traders look at as a case study in value destruction. What most people see as a penny stock, what is really happening is a desperate last-ditch pivot. Until very recently, this company was not known as AiRWA. It was a company called Connexa Sports Technologies. It was in the business of sports, media, and recreational products, an understandable, if not particularly exciting sector. But that entire model has been thrown out. The company is now attempting to rebrand itself as a blockchain and digital asset player, specifically focusing on tokenized real-world assets and integrating with platforms like Solana. This is the definition of a Hail Mary pass. The market's expectation was that Connexa Sports would either slowly fade away or find a niche. The reality is that the management team has decided to light the remaining structure on fire in hopes that a new one, built on crypto, rises from the ashes. And so far, the market is signaling a complete lack of confidence, pushing the price down to a level that implies imminent failure. The daily movement we are seeing today is pure capitulation. The stock opened at $1.53, tried to rally to $1.60, and was then summarily rejected, falling through the floor to $1.44. It is now bouncing weakly off that low. This is not fundamental trading. This is algorithmic selling, stop-loss hunting, and panic from any remaining retail holders who just want to get out with anything left. The volume is significant for a stock at this price, suggesting a large number of shares are being dumped. The bid-ask spread is likely wide, making it difficult to exit a position of any size without causing further slippage. This is a classic micro-cap death spiral accelerated by a fundamental identity crisis. The news feed is a mess of contradictions. Just recently, there was an announcement about acquiring the remaining stake in a subsidiary, YYM, for $36 million in cash. This is a confusing signal. A company trading with a market capitalization of barely $30 million is making a $36 million cash deal? This discrepancy alone is a massive red flag and suggests that public data aggregators are struggling to keep up with the company's true financial state, outstanding share count, or the nature of that transaction. It's possible the market cap is wrong, or the deal is not what it seems. Then there is the insider activity. Filings show that Michael Anthony Belfiore, a significant owner, has been purchasing shares. On one hand, insider buying is often seen as a bullish signal. It's the skin in the game argument. The expectation is that management knows something positive that the market doesn't. But here, the reality is far murkier. When a stock is down 99%, insider buys can be a desperate attempt to signal confidence, a token gesture, or even a strategic move to maintain a certain ownership percentage in the face of massive dilution, which is common after such a collapse. With the recent 1-for-50 reverse stock split, the share structure is already compromised, and a 1-for-50 split is one of the most bearish signals a company can send. It is an admission that the stock price has fallen so low that it risks delisting from the Nasdaq, and the only way to get the price back up to compliance levels is to artificially bundle 50 old shares into one new, more expensive share. This move almost never works out for long-term investors. It's a cosmetic fix that does nothing to solve the underlying business problems, and in this case, it clearly failed, as the stock has just continued its downward march. Let's talk about the short interest, because in a situation like this, it is a dominant factor. While specific data isn't always available in real time, a 99% drop, a failed reverse split, and a pivot to the crypto space is like blood in the water for short sellers. The narrative is just too easy to bet against. The short thesis is simple. Conexa Sports was a failing business, and this new AiRWA rebrand is a poorly disguised attempt to catch the tail end of a crypto trend. The shorts are betting that this pivot will fail, that the company will burn through its remaining cash, and that the stock will eventually go to zero or be delisted. They are looking at the massive gap between the $274 high and the current $1.55 not as an opportunity, but as a confirmation of their thesis. They are likely piling on, borrowing shares and selling them, adding to the immense downward pressure we are seeing today. For retail investors, it's vital to understand what this means. You can find short interest data on most major financial platforms like those from FINRA, which reports it bi-weekly, or on specialized data terminals. You would be looking for the short interest as a percentage of float. Anything over 20% is considered extremely high. You should also look at the days to cover, which tells you how many days of average trading volume it would take for all the shorts to buy back their shares. A high days to cover ratio combined with a high short interest can sometimes create the conditions for a short squeeze. But let's be very clear about the risks. Trying to play a short squeeze in a stock like YYAI is not investing, it is gambling with fire. The reality is that the shorts are, in this case, almost certainly right about the company's fundamentals. Chasing a squeeze means that you are betting that you can get in and out before the music stops, and you are betting against professionals who have much deeper pockets and a much clearer strategy. They are perfectly happy to let the stock run 50% in a day, only to short it back down from a higher level, wiping out the new buyers. What's your take on the rising short interest? Smart money or manipulation? The discussions online, on forums, and on X are predictable. You have two camps. One group is screaming that this is a scam, a rug pull by management, and warning everyone to stay away. The other group, a much smaller and more embattled cohort, is trying to find hope. They're latching on to the Solana news, the RWA buzzword, and the insider buys as proof that a massive turnaround is just around the corner. This is the classic expectation-reality gap in real time. The reality is that this company's pivot makes very little strategic sense. It's jumping from a physical products business into one of the most complex, regulated, and competitive digital fields on the planet. They are now competing with crypto-native companies, massive exchanges, and venture-backed platforms. It's unclear what intellectual property, expertise, or competitive advantage Conexa Sports, now AiRWA, brings to this fight. The $100 million blockchain investment mentioned in some reports sounds impressive, but where is that coming from? Is it a firm commitment? Is it dilutive? These are the questions the market is asking, and the answer it's giving is a resounding no. So what does this company, AiRWA, actually do now? Or what does it claim it wants to do? Its previous life as Conexa involved sports equipment, particularly for tennis, and a media platform. It was a tangible business. You could understand it. The new AiRWA, according to its own sparse press releases, wants to build an exchange for tokenized real-world assets. This means taking things like real estate, art, or even future revenue streams and creating digital tokens on a blockchain, like Solana, that represent ownership in those assets. This is a very complex idea, legally and technically. It requires massive expertise in securities law, blockchain technology, and financial market structure. The fact that the company just announced a $30 million test settlement of tokenized equities for a user base on another platform, JUCoin, is interesting. But it's also a headline that is very easy to put out and very difficult to verify in terms of actual recurring economic value. It all feels very promotional, which is a common tactic for a company whose stock is in freefall. They are trying to change the story, but the market is only reading the stock chart. Looking forward, the outlook for YYAI is bleak. The expectation of a turnaround is built on hope. The reality is that the company is facing overwhelming obstacles. The first scenario, and the most likely, is a continued slide into sub-dollar territory. If it stays below $1 for 30 consecutive trading days, the Nasdaq will issue another delisting warning. The company would then have to enact another even more desperate reverse split or be kicked off the exchange and onto the pink sheet.